Hello, good evening everyone. Today we'll discuss this model called as Walters model, which is earnings based valuation of equity. So though we are using it as an earnings based valuation of equity, its purpose is not to value the shares. Its purpose is to give a suggestion regarding dividend policy. So sometimes people are using this method to value the securities. In fact, this method is not designed for the benefit of the investors to determine the price. This method is designed for the benefit of the company to determine the dividend policy. Okay. Anyway, right. So first look at the assumptions. What are the suggestions made by this model? So these suggestions are purely common sense suggestions. There is no rocket science involved here. There is no complexity involved here. Pure common sense. Pure common sense. Okay. Before going to this suggestion, so we have to understand these two variables. What is R and what is K? What is R and what is K? Okay, often students confuse between this R and KE. So R refers to return on equity. We should understand the difference between return on equity and required return on equity. Return on equity and required return on equity. Return on equity. Return on equity. So return on equity refers to the income earned by the company. Refers to the return earned by the company. Return earned by the company. Return earned by the company from the business. Return earned by the company from the business on amount invested by the equity shareholders, and the amount invested by equity shareholders, and the amount invested by equity shareholders, and the amount invested by equity shareholders. This is what the point. Return refers to the returns earned by the company. It's very important. Return refers to the return on equity refers to the return earned by the company. Return earned by the company. Okay. So return earned by the company. Return earned by the company. Next question comes is required return on equity. Required return on equity. This is popularly called as opportunity cost of capital. Somebody may call it as an opportunity cost of capital, opportunity cost of capital, or cost of equity, or simply required rate of return. There are many names for this required return on equity. So it refers to the return expected by the. It refers to the return expected by the return required by the investors. Return required by the investors from the company. Return required by the investors from the company. It is their expectation from the company. How much they are demanding from the company, or how much they can demand. Based on the risk characteristics of the company, how much they can demand. So how much investors are actually demanding, or how much investors can demand. So it depends on, it's about the return on equity, required return on equity. Okay. So if you look at this point, so this is the difference between return on equity and required return on equity. Look at this. So when the shareholders invest money, okay, right. So when the shareholders invest money in the company, when the shareholders invest money in the company, and the company in turn deploys that money in the business, and the company in turn deploys that money in the business, the return earned by the company from the business, it is called as return on equity. It is called as return on equity. Return on equity, or R. So, and how much shareholders are expecting from the company? How much shareholders are expecting from the company? It is called as KE, or cost of equity. Cost of equity, or required return on equity. Required return on equity. It is called as a required return on equity. This is the basic difference between return on equity and required return on equity. Don't confuse, both are one and the same, both are completely different. In other words, in simple words, it refers to the company's performance. Return on equity refers to the company's performance. Return on equity refers to the company's performance. Required return on equity refers to the shareholders' expectations from the company. Investors' expectations from the company. investors expectations from the company. Okay, so required return on equity refers to the investors expectations from the company. It is obvious when the company is able to deliver more than the investors expectations, then obviously the share price will increase. If the company is unable to meet the expectations of the shareholders, obviously the share price will decrease. That is a pure common sense concept. Okay, right. So this is what the point was. Now the question comes is, sir, on what basis they have arrived at this figure? Say for example, a company is earning some 10%. Company is earning some 10%, and the shareholders are expecting say some 8%. Shareholders are expecting say some 8%. So on what basis they have expected this? On what basis they arrived at this figure? There are two different perceptions. So when you call it as an opportunity cost of capital, okay, I don't want to use this term, but popularly the people are using this term opportunity cost of capital. According to me, it is not correct to use the term opportunity cost of capital. It refers to what is the other investment opportunities they have. Other investment opportunities. So how much is the shareholders are able to get return from other investment opportunities? That is nothing but opportunity cost of capital. Okay, so if the investors rather than investing in our company called as TCS, if they invest in some other company called as HCL or Mindtree, how much they will get? They're expecting the same opportunity cost of capital. How much the investors has lost or sacrificed by investing money in the company. Okay, that is what the point is. According to me, it is not correct to use this terminology. Why it is not correct? The reason is that you cannot demand from the company based on your other investment opportunities. You can demand from the company only based on the risk characteristics of the company, based on the risk characteristics of the company, and based on the business done by the company, not based on the not compared to the others. As simple as that. Okay, so I cannot demand more fees based on my other investment opportunities. I can only demand fees based on what I am delivering to you, not what is available to me. There may be 101 opportunities available to me, so based on that you will not pay the fees to me. So you'll pay the fees based on what I am delivering. Okay, as simple as that. So therefore, investors, according to me, it is not appropriate to use the opportunity cost of capital. I am running one software company. Okay, so I'm running a software company for past 30 years. There is no much risk involved. Those slight fluctuations are there, almost stable. Business is almost stable, and I have invested some other emerging company which is able to deliver double-digit growth of 20% or 25%. When you come and ask me, I can't pay the same point. I can't pay the same return, and you can't ask me also, because that risk is different and this is different. The persons who are using this concept called as opportunity cost of capital, what they will use, that they will identify the similar risk characteristics. Their assumption is that we can identify similar risk characteristics company. So this company and this other investment opportunities, similar risk. If both are having similar risk return characteristics, then only can utilize this opportunity cost of capital. But in real life, it is very hard to find two companies having identical risk return characteristics. In real life, it is very difficult to find out two companies having similar or identical risk return characteristics. That is first point. They may be the same business, but risk return characteristics are different. The size of the entity and its existence and brand name in the market and the management integrity, employees loyalty, everything matters. Employees loyalty, everything matters. That is first point. So therefore, in order to use this terminology called as opportunity cost of capital, one, we should be in a position to identify the other investment opportunity with similar or identical risk return characteristics. That is not possible. Second, if you get some other investment opportunity, some people are arguing that we can make adjustments. So if this risk is less and this risk is more, we can make adjustments. But that adjustments also arbitrary. It depends upon the analyst choice. So therefore, I am not comfortable with this. Called as opportunity cost of capital. I don't want my company to look at on a relative basis. Look me at a standalone basis. Don't compare me with other companies. Okay, what is the risk involved in my company? Accordingly, as simple as that. Okay, so standalone basis, absolute basis, relative basis always will have a prejudice. If there is something wrong, it will reflect on other companies also. If some company is highly valued because of share rigging or something else, etc., so you are forcing the other company also to pay the same return. It's not correct. So therefore, I don't want to look at my company on a relative basis. Look me at as a standalone basis, absolute basis. What is my risk? Accordingly, I look it. That is what the point. So therefore, I used to call it as a entitled rate of return. How much they expect from the company. They can expect from the company based on the risk involved. How much they are entitled from the investor, company. According to me, what I would like to use is the entitled rate of return. So this is the word coined by me. So this is the word coined by me. Okay, so all the people are using these words called as required return on equity, opportunity cost of capital, cost of equity, all this point. So what I'm saying is entitled rate of return. Based on the keeping in view the risk involved in my company, how much return for you are entitled. I'm least bothered about other investment opportunities. Okay, that is what the point. Entitled rate of return. Okay, anyway, so in simple words, it refers to the company's performance. Return on equity refers to the company's performance. Required return on equity or cost of equity or opportunity cost of capital or required return on equity, all this refers to the investors' expectations from the company. Right. So these are the two variables. Before going looking at the suggestions of this model, these are the points. Okay, right. Next, look at this point. So R minus R greater than K. That means when the company is able to earn more return than the shareholders' expectations, or the shareholders' other investment opportunities, When the company is able to earn more than the shareholders' other investment opportunities, it is correct. Optimum dividend payout ratio is 0%. Why optimum dividend payout ratio is 0%? Since the company is able to earn more, it's better the profits are retained within the company, so that investors will get more benefit. Okay, so this is the scenario, and this is the suggestion, and this is the reason for the suggestion or justification for the suggestion. As the company is able to earn more return than the investors able to earn elsewhere, it's better the company reinvest the profits on its own. Next, this is the reverse. When the shareholders are able to earn more return elsewhere, it's better the company will pay entire amount as dividend. When the shareholders are able to earn more return elsewhere, it's better the company will pay entire earnings as dividend, so that shareholders will invest elsewhere and they will get more return. Emma, these are the suggestions used by this model. Pure common sense based suggestion. There is nothing wrong in that, and it is very simple. There is no complicated suggestions also. But according to me, so what this conclusion of this model is that, so this model says you can increase your share price by using your dividend policy. So the ultimate conclusion of this model is that you can use the dividend policy to influence your market price of stock. So you can use the dividend policy to influence the market price of the stock. So when the R is greater than KE, by retaining more profits and paying less dividend, we can increase the market price. When the KE is more, by paying entire amount as dividend 100%, we can increase the market price. By doing this, you can increase the market price. This is what the suggestion. I'm not denying the suggestion, but the market price may not increase as suggested by this model. So according to me, the market price may not increase as calculated by this model. So this model says, if you pay this much of dividend, your market price will be this much. If you pay this much of dividend, your market price will be like that. So according to me, what I can accept from this model, what I will not accept from this model is that I'll accept the suggestion. But what I'm contending is that your share price may not increase to the extent suggested by this model. Okay. So why? Because of the two unrealistic assumptions. I cannot call it unrealistic assumptions. I'm not convinced with those assumptions. Now I'll tell you what are those assumptions. What are the assumptions which I'm not convinced in this method? Why I'm saying the market price computed under this method may not hold in real life. Okay. Right. So if you look at the formula here, according to this model, so the price of a share depends upon, this is the formula used to calculate D plus E minus D into R by KE divided by KE. Emma, I have already explained you. Once again, I'm repeating. If you value any asset, any method. The value depends upon the present value of future cash flow. That fundamental thumb rule will not change. Okay, any method you use, the value depends upon if any method is inconsistent with that fundamental principle, you have to completely ignore that method. Okay, so therefore value of a stock is nothing but discounted value of the future cash flows. Okay, right. So if I invest in equity shares, what are the two cash flows I'll get? If I invest in equity shares, investment in equity shares will give two types of returns. What are the two types of returns? Investment in equity shares will give two types of returns. The first return is dividend. Another return is capital gain. Investment in equity shares will give two types of returns. One is dividend, another one is capital gain. Okay, so if you look at this point, it refers to the dividend income. This refers to the dividend income and refers to the capital gain So this is the dividend amount. This is the dividend amount. dividend amount, not dividend rate or payout ratio. There are different terminologies that we'll discuss in the next lecture. So dividend amount, this is the capital gain amount. Be clear, amount, not percentage. Capital gain amount. Capital gain amount. First discuss those above points. So the dividend plus capital gain, dividend plus capital gain is equal to total income. Dividend plus capital gain is equal to total income. Dividend plus capital gain is equal to total income. Okay, right. Now I will discuss why, sir, why I'm calling it as a capital gain. This portion is called as a capital gain. This portion is called as a capital gain. Right. So why that portion is called as a capital gain? There is the flaw involved in that portion only. That is the reason I'm suggesting that you may not get the market price as computed by this model. Our market price definitely will increase. In this kind of scenario, if you use this dividend payout ratio, definitely our market price will increase. I'm not denying that, but may not be to the extent predicted by this model. Okay, may not be to the extent predicted by this model. Let me show the assumptions, some assumptions which are not comfortable in this calculation. Okay. Here, what does that says? E minus D. Take E minus D. So this E refers to earnings per share. Say for example, my earnings per share of 10. My earnings per share is 10. Out of that, dividend per share is 8. Dividend per share is 8. Earnings per share is 10. Dividend per share is 8. So earnings minus dividend is equal to retained earnings per share. Retained earnings per share. All the calculations we are doing on per share basis. Retained earnings per share is equal to 2. Retained earnings per share is equal to 2. So here I'll get the 2 point. So by the difference between this 8 minus 2, I'll get 2 point. So on this 2 rupees, company is reinvesting in the business. This 2 rupees, company is reinvesting in the business. So if the company reinvests this 2 rupees in the business, on that company is getting 10% return. This is R. This R refers to the, I said no, R refers to return on equity, return earned by the company from the business. Return earned by the company from the business. So on this 2 rupees, company is able to earn 10%. That means 0.2. So this 2 rupees, if you reinvest, you will get 0.2. You will get 0.2 return. You will get 0.2 return. You will get 0.2 return. So here the problem comes. So therefore, total retained earnings are 2. On that you are getting 10%. Therefore, total income is 0.2. Total income is 0.2. So therefore, here the comes is the problem. Okay, right. So why I am calling it as a capital gain means, say for example, if Mr. A purchases the shares, on 1st April 2019. If Mr. A purchased the share on 1st April 2019, so he will be expecting dividend. He will be expecting dividend of rupees 8. He will be expecting dividend of rupees 8. He will be expecting dividend of rupees 8 on 31st March 2020. It may not be exactly on the same date. The dividend may not be declared exactly on the year end. Just for the sake of comfort, I am writing. Okay, right? 31st March 2020. Right. Next, if Mr. B purchases the share from A, if Mr. B purchases the share from A on 1st April 2020, he will be expecting dividend of rupees 8.2. That's what this model says. Rupees 8.2. Why this 8.2? This 8 anyway will continue. This 8 anyway will continue. On this he was getting 8.2 because this 0.2 also. This 0.2 is the first year profits invested. So this 2 rupees is the first year profits invested. On this profit, 0.2 is the second year profit, second year additional profits. More profits in the second year compared to the first year. Emma, what is that 0.2? More profits in the second year compared to profits in the first year. First year we got 8 rupees, second year we are getting 8.2. That means B is able to get 0.2%, 0.2 rupees more dividend than what A got. Okay, so it implies that B will be getting 0.2 rupees. B will be getting 0.2 more dividend than A. So accordingly, he will be paying more money than what A has paid to purchase the shares. Okay, this is what the point. He was going to get 0.2 more dividend. For this, how much B is in a position to pay to A more than what A has purchased? Say for example, if A has purchased at 100 rupees, B may be paying to A 1 or 2 rupees or 1 or 3 rupees. This 3 rupees extra. Why B was paying this 3 rupees extra? Because B will be getting more dividend than what A. If A has paid 800 rupees to get 8% return dividend, B may be paying 103 to get 8.2. Just for the sake of example, I have given. Just to understand the logic. Don't go by the mathematics. Just to understand the logic. Mathematics I'll explain now. Okay. Right. So 0.2 more dividend than it. That much clear. Now, so now the different. Now we have to understand the variables. After understanding this, so this portion, I'm not completed this format. I'm not completed this formula. Just check up this format. So what I have completed is this portion. So till now, whatever I have completed is this portion. What portion? What till now I have completed this much of portion. This much of portion. Okay. This dividend amount is clear. This is the amount. This is the amount extra dividend. Emma, this is the extra profits in the next year, extra profits in the subsequent years, which we are expecting in the form of dividend too in the second year. Okay, right. Now we'll discuss this portion. Why it is key? Why it is key? If B is able to get 0.2 more profits, he is not paying 0.2 extra. He'll be paying more than that. For that, now we should understand. Okay. Now understand the three terms. Three terms. Popularly, we are using three terms. Okay, that is called as return, income, investment. Return, income, investment. Okay. So what is meant by return? We are using in various places. We are using the word called as return. So first of all, we understand what is meant by return. What is meant by return? Emma, return refers to income expressed as a percentage of investment. Forever remember this fundamental principle. Never ever go by the formula. Never ever go by the formula. Just remember this fundamental principle. Return refers to income expressed as a percentage of investment. Return refers to income expressed as a percentage of investment. So therefore, what I should call it as a return is equal to income divided by investment. Income divided by investment. Return refers to income divided by investment. Okay. So investment is nothing but purchase price. Investment is nothing but purchase price. Investment refers to purchase price. Investment refers to purchase price. Investment refers to purchase price. Okay, right. Investment refers to purchase price. So if I convert this formula, return is equal to income by investment. My investment is equal to income by return. My investment is equal to income by return. Income by return. Income by return. Required return. Income by my required return. Okay, right. So here B was getting extra income of 0.2. B was getting extra income of 0.2. Am I correct or not? B was getting extra income of 0.2 when compared to A. For that, B's required rate of return is say 8%. B's required rate of return is say 8%. So he was going to get 0.2 extra return. B's required rate of return is 0.8%. So therefore, how much extra investment? When compared to A, B is not getting 0.2. B is getting 8.2. 0.2 is the extra because capital gain refers to extra. Capital gain refers to purchase sale price minus purchase price. Excess of sale price. Am I correct or not? Capital gain refers to the excess of the sale price, not complete sale price. So therefore, only I'm taking extra investment. This extra cost to B when compared to the cost incurred by A is called capital gain to A. You got the point? This extra cost to B more than the cost of A is called capital gain to A. Okay, right. So how much is that? Let's look at this calculation. Okay, so 2 divided by 0.2, how much will get? 2 divided by 0.2, how much will get? Let me calculate that. 2 divided by 0.08. Just a time to do. So let me calculate here. 2 divided by 0.28, right? What we got is 2 divided by 0.28. Okay, ready. So 2 divided by 0.08 is the figure. 2 divided by 0.08. 2 is my income, extra income, sorry, 0.2. 0.2 is my extra income, and that my required rate of return is 0.08. 0.2 is my extra income, and that required rate of return is 2.5. Emma, this 2.5 is the excess price which B was willing to pay more than the price paid by A. Emma, this 2.5 is the excess price B is willing to pay more than the amount paid by A. More than the amount paid by A. Okay, right? That 2.5 is A's capital gain. That 2.5 is A's capital gain. This 2.5 is A's capital gain. B is willing to pay more than the what A has paid. So therefore, total A's income how much? Total A's income is 8 plus 2.5. 8 plus 2.5. Total 10.5 is A's income. Total 10.5 is A's income. Same method. Same method. So what is the return? Return is equal to income expressed as a percentage of investment. Income expressed as a percentage of investment. Okay. Right. Next. So therefore, investment is equal to investment or price is equal to income by return. Okay. Price or investment. Price or investment is equal to income by return. Income by return. Okay, what is the income? 2 incomes. Dividend 8 rupees and capital gain 2.5. Total 10.5. And my required rate of return is 0.08. So 10.5 divided by 0.08. How much I'll get? 10.5 divided by 0.08. So 10.5. So 2.5 plus 8. 2.5 plus 8, 10.5 divided by 0.08, divided by 0.8. I'll get 131.25. This is the price. 131.25. This is the price. This is how the Walters model is used. Emma, this is how the formula is good. This is the logic. Okay. So this refers to the capital gain amount. It refers to the capital. It refers to the extra dividend. Emma, it refers to the extra dividend to be subsequent purchaser. It refers to the extra dividend to be. When you combine this, it refers to the extra price paid by A, extra price paid by B to A. Okay, right. Look at this point. Once again, I'll write those formulas. Okay, in that formula, if you use this point, so what is this? E by E minus. So E minus D. E minus D. What is this? Profits retained. Profits retained. Retention amount. E minus D into R. E minus D into R. Extra dividend to subsequent holder. Extra dividend in subsequent years. Extra dividend in subsequent years. Next, what is the third point? E minus D into R divided by KE. It refers to extra price, expected extra price offered by subsequent holder, extra price offered by subsequent buyer. It is nothing but capital gain to the present buyer. So capital gain to the present buyer. This is what is that point. So once we got that this is 8 and this is 2.5, total 10.5 is the total income. So remember, what is the return? Return refers to the income expressed as a percentage of investment. It is income only, but it is converted and expressed as a percentage of investment. Why income is converted in the form of return? Income is in the form of amount, return is in the form of percentage. Both refers to our profit only. Then why you are converting income into return? To facilitate comparison between one investment and another investment. So if I say that I am getting 20 rupees from TCS and I am getting 25 rupees from HCL, it doesn't mean that HCL is giving more return. We have to look at the investment, how much investment I have made. So therefore, income has to be compared with the investment. Then you'll get the return. Then you can make the comparison. To facilitate the comparison, income is converted into returns. So this is what the calculation. Now come to the main point. What is the assumptions inbuilt in this calculation with which I am not comfortable? So the assumptions inbuilt in this model is, first point, if you observe here, so on the 2 rupees reinvestment, whatever we are getting 0.2, entire amount we are paying it as a dividend. That is what is this assumption. This assumption says entire 0.2 we are getting as a dividend. Earlier, out of, if you got 10 rupees, we are paying only 80% and we are retaining 20%. On this 0.2, we are not doing like that. We are paying entire 0.2 as dividend. That means forever our retained earnings will be 2. Forever our retained earnings will be 2. Our retained earnings will not increase. Forever our retained earnings will be 2. That means I have an investment opportunity in 2020. I have an investment opportunity in 2020. That is the reason I have retained 2. On that retention, whatever I got, entire amount I am paying as a dividend. I don't want to retain any amount on this because my reinvestment opportunity is exhausted here. My reinvestment opportunity is exhausted here. I don't want to retain any amount of this. That's what is assumption built in this formula. According to me, it is not correct. On this also, we should retain some portion. According to me, reinvestment is a never-ending process. On this also, we should reinvest some portion and we should pay only 18%. So according to me, B's excess return will be 0.16, not 0.6, according to me. So therefore, you can slightly change the model. In real life, you can slightly change the model. Okay. So that is one assumption which I'm not comfortable. So the first assumption of this model is that reinvestment amount is same. The profits earned on the reinvestment is completely distributed away. That is one assumption. And second assumption is that if you look at these two KEs in the formula, if you look at, there are two KEs are used in the denominator, 1 KE and the numerator 1 KE. Okay. So when I say P is equal to D plus E minus D into R by KE whole to the power of KE, I am using two KEs here. I am using two Ks here. So these two Ks refers to, this is the required return for A. This is the required return for A. This is the required return for A. And this is the required return for B. This is the required return for B. This is in 2019. This is in 2020. So it assumes that the circumstances are same and the risk return characteristics are the same over a period of year. Therefore, the cost of equity is same. It is not the correct assumption. So if you are using this model in the real life, make two adjustments. One adjustment is here also based on your dividend policy, change this. 0.2 change this 80 into 20. That is first option, first assumption. And the second thing we have to do is that we cannot blindly take this KE to here only. Here we have to use the different KE. Okay, based on the circumstances, you have to predict what would be the circumstances after 1 year. So how much required return of B should be after 1 year, based on the bank fixed deposit rate, based on the economic position, based on the risk return characteristics of the company. By using various variables, we have to use different KE. At least we have to think about how can we predict that the economic circumstances and the company's risk return characteristics will remain same over a period of time. That is not correct. Okay. So this is the assumption. We have to use that. We have to change this assumption. Okay. Emma, ultimately the conclusion is that so the suggestions are correct. The suggestions correct, no doubt. It's a pure plain suggestions. So if you follow this dividend payout ratio, definitely your share price will increase, but may not be to the extent predicted by this model. It may be more or it may be less. In order to get the accurate prediction, you have to make these changes. You have to make these changes. At least definitely have to make these changes. What is the required return on equity today? And what is the required return on equity after 1 year? Maybe now the economic business position is very less. We are into completely lockdown where the business position is very poor. Investors are satisfied with the less returns also. Maybe that is the case. But after 1 year, investors' expectations on the company will be more and the company will be performing more. Risk return characteristics will be different. So therefore use different KE after 1 year. Don't use the same KEs. In real life, don't use the same case. Use different case based on your prediction of economic position after 1 year. Based on your prediction of economic position after 1 year and the company's position after 1 year. Based on your predictions, you have to change them. That's it. Right. So in the next class, we'll see why we have to convert income into return and what is the drawback with these terminologies: opportunity cost of capital, cost of equity, etc. So this we'll discuss in the next point. Next class. Okay, see you. Bye. See you, everyone.